From the morning reading, oil gallops, the Qs, diamonds, SPY, IWM move higher, 3 white soldiers candles. Fossil, Garmin, Priceline soar on earnings per share. 8 of 9 sectors moved higher on Wednesday. XLE, XLY, and XLK were the strongest sectors, while XLU was the weakest sector. Oil rose $2.31 to close at $31.43. Breadth was mixed as advancers led decliners 4.34 to 1 on the New York Stock Exchange and decliners led 2.56 to 1 on the NASDAQ. Correction or bear? There's the big debate on to whether we're in a market correction or a bear market. The fact is we're in both. Market groups in the U.S. that are in bear markets, which are more than a 20% drop, include banks, biotech, small caps, and transports. While the Dow and the S&P 500 are still in correction territory, the New York Stock Exchange Composite Index has lost 20% and the NASDAQ some 19%. Foreign stock indexes in developed and emerging markets have also reached bear market thresholds. So some markets are in bear markets and others in correction. But those are just numbers, and just because something is labeled a bear market doesn't mean it has to continue. What really matters is what the chart looks like. Many of the chart patterns in this and other messages over the past week show that a lot of important market indexes have reached important support levels while in very oversold conditions. The most important of these may be the FTSE All-World Index. Buying interest has been so lopsided over the past 3 days that down pressure reading for the S&P 500 has averaged only 7% over the past 3 days. Since we started calculating this in 2002, there have only been 3 days when the 3-day average got this low. All occurred during pushes off extreme pessimism. The 2009 instance led to immediate selling that persisted, while the latter two led to further buying that also persisted. That's one reason why the reaction of traders to this surge should give us a hint as to the potential for the likelihood of longer-term gains. The past 3 days have been highly unusual. It's been rare in the past 50 years to see such a strong blast off a 52-week low, whether judged by daily price changes, the flow of volume into stocks that are rallying, or many other gauges. Mostly it suggests exhaustion short term, but good signs in the medium to long term. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:55 a.m. Central Time, and I'm recording this in preparation for the market day of February the 18th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, quite a bit of action here in the last 3 days, but also in last night's overnight once again. And indeed, at the time of this cut, the S&P futures are up over 10 points, about 0.5%, building on 3 really strong back-to-back-to-back days. Russell futures are up a little less than 0.5%. NASDAQ up about 0.75%. Dow up about 0.2%. Crude oil continues to make huge moves, up 2.46%. Euro's down about 0.5%. Bonds are essentially scratch, and gold is down about 0.2%. China is down marginally. Hong Kong, though, up big, 2.3%, as is Japan, up about 2.3%. Germany also up pretty smartly, about 1%, with the United Kingdom down about 0.33%. In terms of macroeconomic reports for today in the United States, you have Philly Fed manufacturing, the weekly version of unemployment claims, nat gas, and then also be aware that crude oil has its report today, and both a new day and a new time due to the Monday holiday. In terms of looking forward to tomorrow, we have core CPI and the related CPI reports, and that looks to be about it for tomorrow. Volatility conditions, as you will expect with these 3 white soldiers candle pattern, have come down significantly. Short-term VIX down to a 20 0.27. Skews just below the threshold in which we go to caution status. IV percentile 38 on the S&P, 49 on the Russell, 47 on the NASDAQ, and 41 on the Dow. So also coming down pretty significantly. We have had 3 in a row standard deviation moves on the S&P, and of course those are all up days. So this is a very, very large up move. We also had standard deviation moves put in by all 4 indices yesterday. So very strong bullish move. Let's go to the charts. And of course, the big question is can this persist? And looking here, let's go ahead and go to the futures because it's been so busy in the overnight of late. The question is, after this low was put in at 1802, which is essentially a double bottom, big confirmed reversal pattern. There's obvious here that we have confirmed a short-term trend reversal. We have also moved from market phase 1 into market phase 2 with this action. So we have several signals that have clearly indicated a trend reversal. The big question now is that we're coming into the swing highs, and that's going to be very important resistance. And we're going to have to find out, can we get a higher high? Right now, all we have is a similar low and no higher high yet. So if we're truly going to be in a trend reversal, we have to be able to set higher highs and higher lows. And we've not yet done that. All we have right now is a very, very impressive short-term reversal and trend. We do not yet have an intermediate term trend reversal. Though you could start to argue that at the very least the intermediate term is starting to look more like a sideways or neutral pattern. But to turn that truly into something where we would have bigger expectations, we're going to have to clear this area. So on the S&P futures, that would seem to be about 1940. We need a confirmed close, not just a intraday tickle, but we need a confirmed close up above that area, give us a confirmed higher high, and be able to really feel like we've got something really going somewhere. In terms of the Dow, you could see Dow has already cleared those prior swing highs. So we do have a higher high on the Dow with yesterday's close, not even counting today's action thus far. Now we do have a little bit more overhead resistance right here. So you can see right about the area where in the Globex it turned is some additional resistance. And it would certainly be even stronger if the Dow can close above this level here, about 16,541. That would be very significant there. NASDAQ, you can see we got some room to go. While we've come up quite a ways, we still have some more room to go before we get to this swing high, the all-important swing high, and then a slightly higher swing high. So we've got a real resistance zone right up above this NASDAQ action that's going to be very, very telling. In terms of Russell, it also has some room to go before it gets to the swing high. So just be aware of where we are as you start to put in some new bullish positions. Certainly at this point, and we'll talk about some of those opinions in just a moment, but at this point it is called for to have that foot in the water to start putting in some stuff, but also be aware that you're about to run into potentially a wall of resistance just above your current index levels. In terms of volatility, obviously huge reversal here, though still elevated. You know, this is still not bull market territory when you have the VIX up here around a 23. We need to see this come all the way down here to this below 18. And you can see it has not been able to get below 18 for any time at all in quite a while. Well, that's where bull markets reside, is in that 12 to 18 zone. So don't get complacent because you've had 3 big days. There's a lot more technical damage that needs to be fixed. In terms of bonds, that's also experienced a big reversal, and that pattern has continued, though nowhere near as robustly as we've seen with the indices the equity indices and moving up. If you look at the movement in bonds, it certainly has not got the huge candle bodies going in that direction. And let's see, let's take a look at crude oil. A lot of this has been thought to be responsible because of the crude oil inflection, and you see the big gap here. Now we have had a futures rollover that we're in the midst of, and so forth. So be aware that some of the levels are certainly being reset. But bottom line is we definitely have had, as a percentage, a very, very significant reversal off of a low at 26.05, and we're currently trading in about 33.5. So as a percentage, that is not something to sneeze at. Okay, I think that's probably enough on that. Let's go to the daily report, and we have some very important changes here today. So a lot of times these changes are incremental, and we take great note of the changes from one day to another. Well, today we have some very important changes. We have moved to phase 2 in our market trend intermediate term phase opinion, and this is called the trend reversal, or the foot in water. Certainly selling put still, but also more normal size stock positions is normally called for in phase 2. We also have had IBD status on the portfolio investor posture change to confirmed uptrend. Now, I will remind you that we've had something like 14 months, some 13, 14 of these confirmed uptrend signals during the last 14 months, which of course we've spent mostly range bound. And all of those prior confirmed uptrend signals have failed to follow through. We're a huge fan of IBD, but this is a reflection of a range-bound market, and you get on these crossover kind of systems a lot of choppy whiplash movements that fail to follow through on both sides. You could also argue we've had 13 market and correction signals that have largely gone nowhere as well. Obviously, we were experiencing something like a 200-point range, which is a wide range, but ultimately we've not been in a clear bullish or a clear bearish market during that time. Accumulation distribution score on the S&T is still a lousy D-. The NASDAQ still a very lousy E. So breadth continues to be an issue around this around these charts. GMI index did improve one notch, but still retains that sell signal and has been so since 1210. So this signal has been much more stable of late. That author remains 100% in cash. On the decision point scoreboards, we've had some changes. We've had short-term PMO signals, which is part of our market posture signal system, has flagged on the S&P, both 100 and 500, as well as the Dow. And you note that in the short to intermediate term, we're mostly got gray, neutral signals, and that makes sense. And in fact, remember when we looked at the chart, we talked about the fact that on the intermediate term, really that chart is more about a range-bound action. Recent days to weeks, if you take a 3-month period, most of that 3-month period is sideways between a similar bottom and now relatively similar highs. So, you know, obviously the action leading into this was range bound, then broke down, but now seems to have gone into another range until proven otherwise. So our intermediate term probably is best described as neutral. In terms of the position sizing opinions, with that IBD status changing, that now flips to 100% on the portfolio. On the active trader volatility-based system, that is in the 50 to 75% range. So increasing improvement there is being seen as well. And also in the intermediate term market posture, we have also seen improvements there, with 3 of the markets now in a weak bull, up over 20. The NASDAQ just barely so, but still, most important one is the S&P, and it clearly is up over 20. So we have a weak bull, but we also have it matched with the Russell still severely bearish and on the S&P, a very bearish sentiment line. So very mixed signals. Probably we say weak bull, we say very bearish sentiment line, probably best taken as a neutral signal. So don't get too far out in front of these signals. They're clearly significant improvement, and yet it is not an all clear sign as of yet. In terms of hedge warning status, also change here. We've dropped this down to 1+. It was a 2+ yesterday. So with those changes, we have dropped the risk level. Though if this were to go back to those lows, there would be a very large question as to whether those lows would hold and the range would hold, or whether it would break through and we would then make new lower lows. So this hedge warning status can go back up in a hurry if these conditions start to deteriorate once again. But right now we are recognizing the improvements in these technicals and various posture elements, and our risk level clearly is not what it was a week ago. In terms of specific warnings, we still have market in decline, VIX futures up over 18. The week out expected move in the S&P still a bit elevated at a 49. We also have seen pretty significant improvements in the New York Stock Exchange, new highs, new lows. Yesterday, nearly 500 new highs in the 1-month time frame. Also, in the key intermarket risk aversion indicators, a lot of improvement here. I mentioned yesterday we had started to see some rolling up. Well, indeed, 3 of these have now crossed, just barely, but they have crossed to the positive side, which is calling for risk on. And the other 2 are very close to crossing over as well. They're about to roll up and over and put this into a risk on. So all 5 of those are not far away from a risk on indication. In terms of sentiment, the stock short-term risk is an 8, so this is pretty risky. We've obviously gone well over 100 points in S&P futures without a retracement, so just kind of cooking towards a retracement has got to come at some point in the near-term future, and you see that reflected in the sentiment. Medium-term, it's only a 4, so relatively benign. Fear and greed index, a lot of improvement here, all the way up to a 43, still in the fear area, but nowhere near where it was a month ago at a 10, or even a week ago at 16, and yesterday it was a 32. In terms of special opinions, we do have some changes here. In terms of option income strategies, the VIX is still outside the acceptable window to initiate new positions for novice traders. More aggressive traders will be taking advantage of these higher premium levels available, but you've got to know that you've got a position size and you've got to account for expected larger than normal delta and vega moves, and certainly we've been doing that. We've been doing little nibble trades on extreme moves in the market and keeping that position size very small compared to where we would normally be, and expecting and accounting for that we may have to make even one or even 2 or 3 adjustments during the course of that trade's life. In terms of cover calls and put selling, we have had an elevation, and these conditions are now called borderline acceptable to initiate new positions for novice traders. I would still suggest in constructing those trades, much like we've been telling the aggressive traders in the last few days, to be defensive. Look for in-the-money strikes. Look for reduced size, perhaps leg into that cover call by selling an out-of-the-money put. There's a number of things that you can do here, and we talk about this all the time, and you should retain a very, very defensive structure on legging into these bullish trades. Same thing with put selling. Make sure that you are position sizing in the scale you are willing to own, as this situation in 3 days made a lot of improvement, but in 2 or 3 days we could be right back to where we were. We have not healed everything yet. We certainly have made improvements. In terms of sector market posture, you could see also improvements showing up here. Short and intermediate term, everything turning very, very green with some neutrals, but they are starting to become the minority as well. Also in the long term, you're starting to see significant improvements there. Consumer staples continues to be one of the most consistent areas as both a defensive in the recent down move, but also where an awful lot of money is rotating to in the current move. Percent change, you can see big robust moves yesterday. Utilities giving back a little bit, but obviously it's been on a tear of late, and is of course part of the reflection of that defensive move. That should be enough for today, and we're at 20 minutes, so I'm going to go ahead and scroll through these slides. If you see something of interest, just hit the pause button and go to that hyperlink and get the additional information, the additional details. Disclaimers as always, hit the pause button if you need more time to review. Also note the full hyperlink down here at the bottom for the full disclosures. You can see all those pages and pages of disclosures at that site. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.